Imagine a very simple situation. You open your bank account one morning. Inside it, there is $100,000. Not lottery money. Not inheritance. Just the amount you saved after many years of working. Now, the real question is, if you do nothing reckless, no gambling, no chasing get-rich-quick opportunities, how fast could that money become $1 million? Most people, when they hear this question, have the same reaction. They think that to turn $100,000 into $1 million, you have to be a financial genius. You must pick a stock that goes up 20 times. Or you must take part in extremely complicated investments that ordinary people cannot even understand. But the truth in the financial world is completely the opposite. The richest people do not rely on big bets. They rely on something so boring that almost nobody talks about it on social media. Not the newest crypto, not the hot stock of the week, and definitely not complicated trading strategies. What they rely on is a very simple financial machine that has existed for more than a century. That machine is compound interest. In economics and finance, compound interest is often considered one of the most powerful forces in the entire monetary system. Albert Einstein even called it the eighth wonder of the world, not because it is complicated, but because its power is almost impossible to understand intuitively when you look at it with the naked eye. When money starts generating profit, and that profit keeps generating new profit, you are no longer playing a linear game. You enter a system of exponential growth. This is exactly why, in modern history, people who patiently invested in the stock market, especially in broad indexes like the S&P 500, have been able to build such large amounts of wealth over nearly a century. The United States stock market has produced an average return of about 10% per year, including reinvested dividends. That number does not sound very impressive, but when you place it in the context of a long period of time, what happens afterward is completely different. An initial amount of $100,000, if invested with that average growth rate, can grow to $1 million simply through the power of time and compound interest. No need to predict the market. No need to trade every day. No need to become a stock analysis expert. Just the right system and enough time. What is interesting is that most people know the concept of compound interest exists, but very few truly understand how powerful its growth speed really is. Because in the first years, almost nothing remarkable happens. The account grows slowly. The profit is small, and the process looks boring. But that boredom is actually the sign of a system working correctly. In finance, the strategies that look the most boring are often the most effective ones. And the real question we are going to answer in this video is not whether $100,000 can become $1 million. The mathematics of the market answered that question a long time ago. The real question is, how fast can you do it? Part 1, the mathematical mechanism. How 100,000 USD becomes 1 million USD. To understand how $100,000 can become 1 million, we first need to ignore the stories about getting rich quickly and return to something much simpler. The mathematics of the financial market. In long-term investing, money does not grow in a straight line. It grows in a compound curve. That means each year, profit is not calculated only on the original amount, but also on all the profit accumulated before that. Look at a simple example. If you invest $100,000 and earn an average return of 10% per year, in the first year, you make about $10,000. Your total wealth becomes $110,000. In the second year, profit is no longer calculated on $100,000, but on $110,000. That means you earn $11,000 instead of $10,000. In the third year, profit continues to be calculated on $121,000. This process keeps repeating, and after some time, the money begins to grow much faster than our intuition expects. This is exactly why in finance, there is a very famous rule called the Rule of 72. This rule is extremely simple. You take 72 divided by the annual return rate, and the result tells you how long it takes for your money to double. For example, if your portfolio grows at 10% per year, your money will double in about 7.2 years. If the return is 8%, the process will take about 9 years. And if you achieve 12%, the money can double in only about 6 years. And this is the important point that many people overlook. To turn $100,000 into $1 million, you do not need a financial miracle. You only need about 3 to 4 doublings of your assets. The process looks like this: $100,000, $200,000, $200,000, $400,000, $400,000, $800,000, $800,000, beyond $1 million. What makes this process special is that each doubling afterward feels faster. In the early stage, you may spend many years just to gain a few tens of thousands of dollars. But when the portfolio reaches several hundred thousand or close to 1 million, the market can generate tens of thousands or even hundreds of thousands of dollars per year without you doing anything extra. That is when the compound interest machine truly starts working. In modern financial history, investors who stayed patient with the broad market, especially index funds that track large economies, have often used this exact mechanism to build wealth. The stock market does not grow evenly every year. Some years rise sharply. Some years fall deeply. But over long periods of time, the overall trend of large economies has always been growth, along with the expansion of businesses, technology, and productivity. And that long-term growth is the foundation of the entire compound interest system. But there is one important thing many people do not realize. Compound interest is not the only factor that determines how fast you reach $1 million. In fact, there is another factor that is even more powerful in the early stage of the investing journey. Part 2. The acceleration factor. What makes your money grow faster than most people think? When talking about investing, many people become obsessed with one familiar question: how can I earn a higher return? They search for the fastest rising stocks, try to predict the market, or constantly move money between investments hoping to find a better opportunity. But in reality, investors who build lasting wealth focus on a completely different factor, not the rate of return, but the cash flow they continue to put into their investment system. This is one of the least discussed ideas in personal finance. Because in the early stage of the investing journey, the amount of money you save and invest each month often has a bigger impact than the market return itself. Let us go back to the original example with $100,000. If you invest that amount in the market and earn an average return of about 10% per year, your portfolio may reach $1 million in about 24 years. That is the power of compound interest with only the initial capital. But something interesting happens when you start adding money to the portfolio regularly. Suppose you still invest $100,000 at the beginning, but each month you add $500 more. No change in investment strategy, no change in return rate, just adding money into the system. The result is that the time needed to reach $1 million drops to about 16 years. With an additional investment equal to a car payment or a few small monthly expenses, you shorten the wealth building journey by nearly a decade. If you increase the contribution to $1,000 per month, the process becomes even faster. The $1 million mark can be reached in about 13 years. This reveals a very important truth in personal finance. In the early stage, Your saving rate is the most powerful growth engine. Look at a simple example in the first year of the investment. If your $100,000 portfolio grows by 10%, you earn $10,000 in profit. But if in that same year, you invest an additional $12,000 from your income, then your contribution is actually larger than the return from the market. In other words, in the early years, you are the most important investor in your own portfolio. Only after many years of accumulation, when the portfolio begins to reach several $100,000 or more, does the market return gradually become the main driver? That is when the system starts to reverse. Investment gains can exceed the amount you are able to save each year. But before reaching that stage, there is another mistake that causes many investors to lose their advantage. That mistake is trying to predict the market at the right time. Many people believe they need to wait for the perfect moment to invest. They fear market declines, fear crises, or think there will be a better opportunity if they wait a little longer. The problem is that financial markets do not work that way. In many studies of stock market history, researchers found that missing just a few of the best days in the market can significantly reduce long-term returns. The reason is simple. The strongest market gains often happen right after periods of volatility or sharp declines, when many people are staying on the sidelines out of fear. This leads to an interesting paradox in investing. People who try to predict the market often miss the very moments that create most of the profit. Meanwhile, investors who stay consistent, keep investing regularly, regardless of whether the market goes up or down, are usually the ones who capture the full power of compound interest. This is also why in finance, one principle is almost always true. Consistency matters more than perfection. No need for complicated strategies. No need to predict the market every day. Just invest regularly, reinvest the returns, and keep contributing over time. But there is still one final question. If someone truly stays committed to this system for many years, what happens when their portfolio finally passes the $1 million mark? Because at that point, everything begins to change in a way that very few people are prepared for. Part 3. When compound interest starts running on its own, the real turning point of wealth, there is a very interesting moment in the investing journey that many people do not notice until they actually reach it. It is the moment when money starts making money faster than you can earn from your job. In the early stage of the financial journey, you create most of the growth. You save money. You invest more every month. You build the foundation of the portfolio. But when assets reach a certain size, your role begins to change. Look at this very simple difference. If you have a portfolio of $100,000, a 10% yearly return gives you about $10,000 in profit. But if your portfolio reaches $1 million, a 10% return equals $100,000 per year. That is a completely different scale. At that point, the market begins to do most of the work. Compound interest is no longer a theoretical idea. It becomes a real financial engine. This is also why many investors say the first $1 million is always the hardest milestone. Because before reaching that point, most of the wealth must be built through discipline, saving, and patience. But after passing it, each new cycle of compound interest can happen much faster. For example, if a $1 million portfolio continues to grow at 10% per year, going from $1 million to $2 million may take only about 7 years. After that, going from $2 million to $4 million may also take only about 7 more years. This does not happen because you become a better investor. It happens because the size of the capital is finally large enough for compound interest to operate at full speed. However, when talking about money in the long term, there is one factor that cannot be ignored: inflation. If inflation averages about 3% per year, The purchasing power of $1 million in 15 or 20 years will be significantly lower than today. That means the real financial goal for many people should not stop at 1 million, but may need to be 1.5 million or $2 million to reach true financial independence. The good news is that the formula to reach those numbers does not change. It is still the same principle that has been proven throughout the history of financial markets. Start as early as possible. Invest consistently. Reinvest the profits. And stay patient long enough for compound interest to do its work. The difference between the person who eventually builds large wealth and the person who never reaches that point is usually not intelligence, information, or opportunity. It is behavior. One person invests automatically every month and almost forgets about the portfolio. Another person keeps checking the market, worries about every fluctuation, and always thinks they will start investing next month. Over time, these two paths lead to completely different results. The financial market is not a game for the fastest people. It is a system that rewards the most consistent ones. And if there is one thing you can take from this entire story, it is this: the mathematics of wealth already exists. The only question left is whether you decide to use it. If you found this video helpful and want to understand more about how money really works in the modern economy, press like and subscribe to the channel so you do not miss the next analyses about finance, investing, and how to build wealth in a sustainable way. Thank you for watching, and I will see you in the next video.